Hey everyone, welcome back to Corporate Decoder, the place where we decode the financial secrets that big companies try to hide in plain sight. This time around, we're diving deep into Cogent Communications Holdings Incorporated's latest quarterly report, and let me tell you, it's a wild ride through debt data centers and some serious network strategy. So, who is Cogent? Think of them as the backbone of the internet, providing super fast internet access, private networks, and even space in their data centers to businesses all over the world. They're the guys making sure your favorite streaming service loads fast and your company's data is always connected. Now, let's peel back the layers of the 30th of September, 2025. Financial filings and see what's really going on. First off, the company overview. Cogent Communications Holdings Incorporated, a Delaware corporation, is a big player in the internet infrastructure game. They boast a massive network spanning 57 countries, connecting businesses and communication providers worldwide. It's a complex operation and as well see. They've been busy making some significant moves. Let's jump straight into the numbers, the heart of any financial report. Looking at their balance sheet for the 30th of September 2025 versus the 31st of December 2024, we see some key movements. Their total assets stand at a robust $3.1 billion, but their liabilities are a hefty $3.18 billion. This means they currently have a negative stockholders' equity, a deficit of $39 million. Now, that might sound scary, but for companies with significant debt and assets, it is not always a red flag if managed properly. What is interesting here is the significant increase in their long-term debt, particularly the issuance of new notes. They've issued a $600 million 2032 notes and $174.4 million of new IPv4 notes in 2025 alone, alongside a $300 million 2027 mirror notes and $206 million existing IPv4 notes in 2024. This signals aggressive expansion and a reliance on borrowing to fuel their growth. Now, let's talk about the money coming in. For the third quarter of 2025, Cogent reported $241.9 million in service revenue, a decrease of about 5.9% compared to the same period in 2024. This dip seems to be driven by them cutting ties with low margin customers they inherited from an acquisition and a decrease in revenue from a deal with T-Mobile. While it's good they're cleaning house, losing revenue is never ideal. On the bright side, their wavelength services revenue saw a significant jump of over 92% year over year, indicating a growing demand for these high bandwidth solutions. Digging a bit deeper, we see a shift in their customer base. Corporate revenue, which is typically from smaller to medium-sized businesses, saw a decrease of 9.5%. This might be a concern considering the current office market with many employees working remotely, leading to lower office occupancy rates. However, their net-centric revenue, which comes from other internet providers and content companies, increased by over 9%. This shows a strong demand from these bandwidth-hungry players, which is positive for Cogent's core business. But their enterprise revenue from large corporations dropped by about 25%. Which could be tied to them shedding those less profitable acquired clients. Now, let's look at where the money is going out. Network operations expenses, which include things like staffing for network management and equipment costs, decreased by 18.5%. This is largely attributed to cost reductions related to the Cogent Fiber business acquisition, specifically lower leased circuit costs. That is a good sign they're streamlining operations after that big purchase. Selling, general, and administrative expenses, meaning the costs of running the business like marketing and office costs, actually went up by 4.1%. But this is explained by the fact that they stopped paying certain transition service fees to T-Mobile in early 2025, which made the 2024 numbers look better by comparison. Their core GSCA costs are likely stable or slightly increasing. And here's where things get really interesting. Interest expense. This line item jumped by a huge 61.4% for the quarter. Why? Well, they've taken on a lot more debt in the past year, including those new notes we mentioned earlier. Plus, the valuation of their interest rate swap agreement is causing fluctuations, meaning changes in interest rates are directly impacting their expenses. This is a big story for Cogent right now. Looking at the cash flow statement for the 9 months ended the 30th of September 2025, Cogent used $4.5 million in operating activities. This is an improvement from $23 million used in the same period in 2024, showing they are getting better at managing their day-to-day operations. In investing activities, they spent $75.5 million mainly on property and equipment, which is a continued investment in their network. However, in 2024, they actually had a positive cash flow of over $42 million from investing, largely due to significant payments received from that T-Mobile IP Transit Services agreement. It seems that cash inflow from that deal has indeed lessened this year. Financing activities show a substantial incoming cash flow of $73.7 million in 2025, a decrease from $181 million in 2024. This is primarily due to the significant debt issuances in 2024, like the $300 million 2027 mirror notes, but also the large debt payments made in 2025, like redeeming their $500 million existing 2026 notes with the new $600 million 2032 notes. It is a constant dance of raising capital and paying it back. Cogent has been paying dividends around $147 million in the first 9 months of 2025. However, this shows a decrease from $141 million in 2024, which is a bit concerning given their overall financial situation. But they have announced a new quarterly dividend expected in December 2025 of $0.02 per share, which indicates they still intend to return some capital to shareholders, albeit at a reduced rate. Here is a significant development mentioned. Cogent is in talks to sell 2 of its data center facilities for $144 million. This is part of their strategy to monetize assets acquired in that big Cogent fiber business deal. It could be a move to reduce debt or reinvest in their core network operations. Remember that big acquisition of Sprint's fiber network? It is still shaping Cogent's financials. They acquired it for what seemed like a bargain, but the integration and ongoing services, like the transition services agreement with T-Mobile, continue to impact their cash flows and expenses, although they do seem to be getting those costs under control. Cogent highlights their competitive advantages, focusing on being a low-cost operator with a single network protocol, a robust IP network combining owned and leased fiber, and a narrow product set. Their strategy also includes expanding their enterprise business and increasing their net-centric market share by offering competitive pricing and a wide reach. They're clearly leaning into their strengths. Their strategy is clear: grow their corporate customer base, expand with enterprise clients, increase their share in the net-centric market, and pursue more on-net customer growth. They're also looking to boost sales productivity and expand their wavelength and optical transport services. This all ties back to leveraging their massive network infrastructure. Let's look at the equity. As of the 30th of September 2025, Cogent reports a total stockholders deficit of $39.17 million. This is a significant swing from a positive $222.8 million in December 2024. This change is largely driven by the net loss they've incurred over the first 9 months of 2025. Which has eroded their retained earnings. They also saw a decrease in additional paid-in capital. This highlights the financial pressure the company is under, despite their strategic growth efforts. So, what is the big picture here? Cogent is in a transitional phase. They've made aggressive moves like acquiring the Cogent fiber business and issuing a lot of debt, which is causing their interest expenses to skyrocket. The push for higher margin services like wavelength is promising, and managing those acquired contracts is key. The drop in corporate revenue and the significant debt load are definite risks. However, their strong position in the net-centric market and their focus on cost control suggests they are working to navigate these challenges. The potential sale of data centers could provide a much-needed cash injection. Cogent is essentially betting big on future growth and efficiency improvements to overcome their current debt and equity situation. It is a high-stakes game, and investors will be watching closely to see if their strategy pays off. Alright, that is our deep dive into Cogent Communications Holdings Incorporated's latest financial report. Was this breakdown helpful? Let us know what you think about their debt strategy and their future in the comments below. If you found value in this analysis, please hit that like button and subscribe for more corporate deep dives. And don't forget to join our growing community on Discord, linked in the description. Thanks for watching, and we'll see you in the next one.